I would like to take this opportunity to reflect a bit, not just on the last day, but the last 5 years and why we're doing what we're doing here and some of our thinking, or at least I can share my thinking, and some of which occurred over cocktails with Julie, in talking about the need for a venue to discuss community banking in the United States. So think back 5 years and actually more, because these things take a little while to plan. And with the backdrop of having come out of, or really not even fully out of, the financial crisis, with extraordinary actions taken by the Federal Reserve, by the federal government, federal regulators, extraordinary legislative actions to address our financial crisis, both trying to prevent a collapse of our financial system and to attempt to address the risks that we thought we'd identified at that time. And as you heard from Cynthia Blankenship last night, as she talked about some of her experiences during the crisis around TARP and making exceptions, trying to understand sub-S banks and small business lending and the role of small banks, that it was a difficult time because in looking at systemic risks, there was a real interest in backstopping our largest banks. And there was a differentiation between our largest banks and the rest of the industry. And there were times when I personally was advocating on behalf of the state system, raising questions about differentiating and the long-term consequences of that differentiation. And at that time, I was asked, why should I care about the future of community banking? Why should we think differently, and maybe about why do we even need to treat banks differently? Or do we need to treat banks differently? Aren't banks banks? A whole lot of questions that you really needed to answer to navigate some of these policy issues. And we continue to need to understand to navigate these policy issues. And to speak to something that Steve Street just mentioned, why is it still relevant? Why is this diversity, is it just a legacy of our history that we have these thousands of banks? Why is it still relevant to our economy and our financial system? So I already knew that there was a dearth of research and understanding, but a lot of anecdotes around this. I come from a world of the states where they didn't ask those questions. They worried more, what is this community going to do if we lose this bank or another bank? What does this mean to rural America, where they understood it was effectively the banking system of rural America, the community banking system? So matching up these things was a bit of a challenge. I knew that there were two data points that made it pretty clear that one, the power of data and information beyond the anecdote to put things in context. But there were two things in the financial crisis that you did hear, and that was one, that there was a disparity in the response between the largest banks and the smallest banks in how they continued their lending through the crisis and their small business lending through the crisis. And that said, there's something different going on here. And the other statistic was, and not really very well understood, but a generalized, community banks do about half of, and you can argue in defining what small business lending is, half of the small business lending in the US. And in spite of a consolidating industry in the asset side, and so often Washington was focused on the banking industry through the lens of assets. Who had the most assets? That's where the risk was, that's where we should focus. But when you looked at a part of the industry that had maybe 15% of the assets, doing 40 some odd percent of the small business lending, as you dug a little deeper, even more of the customized small business lending, this seemed very relevant. It felt like we needed a deeper understanding of this part of the industry, that this was critical to things that we knew in the financial crisis, which is coming out of it, we'd need to rely on growth of small business and small business employment that tends to lead out of a recession, and we should be paying attention to the ecosystem that supports small businesses. So with just those two data points, a couple of us talking, particularly Julie, about well, maybe we need a better understanding and not just take for granted this part of the financial system and how we regulate it and the impact of regulation on this part of the financial system. And that's where we started. One, is it still relevant? Are we spending a whole lot of time and energy on a part of the system that, the power of technology has obliterated time and distance, and this dispersion of institutions doesn't matter? Or is there something here that is still relevant? And what we've come away with, one, after 5 years, are over 50 papers and more submitted. The quality of those papers has improved over time. We had a sense this would happen, creating a place to come, to creating a community of research would provide incentives to focus on this area of research that we thought we needed. And so we have seen that. We've now had 5 years of survey, something that's unique in providing an understanding, and I think a growing understanding of community banking and what's impacting community banks, and numbers like, which takes it beyond the anecdotal, of the percentage of income dedicated to compliance, and the growth in that area is significant. It shows you that when you hear from community banks, one more thing is really going to make a difference. You can start to see how that one more thing really makes a difference in terms of additional cost to a financial institution. So we have that growth and understanding of better data that we can tie to individual institutions and call report data and create even a better body of research. So we've seen these things. We've started in this process a case study that's getting young people interested in the banking system and understanding the banking system. And I think coming from a college town and environment, to understand how your local banks support the community around you is an interesting thing for young students. But we've created that ecosystem of interest. And we've brought to this subject, and this was Julie and my shared goal, the discipline and rigor of academic research to policy questions where we had and continue to have very imperfect information. And that better information creates better policy. Challenge our assumptions, disagree with us, sometimes affirm what we think we know, but a really robust conversation around things that do seem to matter, that they're relevant given the disproportionate contribution of these institutions that have 15% of the assets of the banking system. I think one of the most consistent things that I've heard over these 5 years is that proximity does still matter in our economy. So while information technology has made distance matter less, it still matters. And sometimes it can trick us into thinking that it matters less and blind us to things that we could see if we were closer to information. So that proximity still seems to matter. And we saw that in previous years around the performance of small business loans, that the closer the lender to the small business borrower, the better the loans performed. And interestingly, but probably not surprisingly to any community banker, the better the small business performed, given that they were closer to the lender. So these relationships do matter. Because of these relationships, the borrowing is more sustainable during a business cycle than it might be if they're relying on funding from the capital markets. So this distance, this proximity, is still a relevant thing. We've heard, over the last couple days about proximity of regulators. And does that matter? Is that something that we need to think about? So I would say that that's one of the key takeaways, is that this still matters. We're still figuring out how much it matters. It's changing. Technology is going to drive change in the financial services industry. And we continue to need to focus on where it matters and how we provide that value of proximity. That is the foundation of the system that I represent, is that proximity mattered. And so, a couple hundred years ago, when our forefathers were debating this, they thought the proximity of the citizen to decision-making mattered. And I think we're still seeing that in our political discourse today, that there is a strong belief that the proximity of the individual to decision-making matters, that there's a desire for that and a desire for that connection. And I think that's something that can't be lost in our discussion on our banking sector and its composition and its relationship to the consumer and the borrower. A couple other things that I'd point out over the years is the observation that the loss of this infrastructure is difficult to rebuild. So that was 2 years ago that we heard that if we continue to have this consolidation, the rebuilding of that is challenging, and we may be losing things that we can't replace, and so we should understand that at least, what we might be losing, and if we can't replace it, or how there might be demands to try to replace some of the things that we're losing if we're losing these local institutions. We've heard a bit about the impact of competition on community banks, but that the community banks have, in the niches where they continue to compete, an advantage over, but that they need to exercise over their decision-making, their customization, and their flexibility. We've heard that the regulatory environment is challenging the ability to exercise that customization, flexibility, decision-making. These are things that we need to obviously think about and address in the near term if we're going to preserve these advantages that seem to matter to the success of small businesses, for instance. I think the observations around CRA, we all can kind of try to figure out, and I'm not sure that we can come to any really good conclusions. But in my own mind, I see that institutions that are connected to their community have incentives to serve those communities in ways that are different than those who are trying to serve a community to satisfy another interest, not their own inherent interest, but another interest, that you serve in a different way. And that might be something that's in play as you think about CRA and who's participating and who the complaints are is how they're choosing to serve a community and really what their incentives are. But we all probably do a little better at what we want to do than we're told we have to do. A couple of other things that I'd add is, we're still a bit perplexed, but some of us apparently less than others on the formation of new charters and institutions. 2 years ago, we heard that this was a big driver of this was monetary policy and yield, and we've heard that from bankers in the room. But I think the important conclusion was that wasn't the only driver. There were things that couldn't be explained. And we had a couple of these presentations of these clips where I noted, I think 2 of them were formed in 1934. So banks forming in 1934. And we had more banks forming in the Great Depression than we did in an environment less economically severe in certain ways than the Great Depression. So there are other factors that we need to consider around bank formation. It may be a change in the business model, a loss of interest in a traditional commercial bank. It may be regulatory burden, but this is important. And I would end with we've heard while there are increased costs, increased regulatory burden, that the business model still seems to make sense despite headwinds, that community banks are still able to make money, that they are relevant, that there are things to be excited about, that there should be opportunities for innovation in this sector. And I think that's the note that I'd like to end on, is that the future is going to require embracing change, but also change on all of our parts. Change on the part of regulators to focus on how we sustain, I believe, need to continue to sustain a diversity of institutions, and the flexibility and the of financial institutions to embrace the kind of change that those of you who are bankers in the room are going to confront. And I think we have an exciting future ahead of us and still lots of unanswered questions. Hope we can continue to do this into the future because I think we are creating an important community around an understanding of community banking in a really unique setting. So with that, please join me in thanking our partners in this and our hosts, partners in the Federal Reserve System and our hosts at the St. Louis Fed, my colleagues at CSBS, and really especially our bank participants, the academics, those who've presented to us today, and our case study winners. I think they've made it a really interesting day. So please join me in thanking everyone.